So the question answer is open to the floor. Anyone has a question? So I'll take the liberty to ask the first question. So my question is, the introduction of corporate tax is actually intended to help UAE achieve its strategic objectives. Could you please throw some light on, what are those strategic objectives? And also, what are the projections of government in the short term and the long run? We have seen they've slashed some of the license renewal cost in the recent past. Is it something to do with the corporate tax introduction? Thank you. Whoever want to take a question, please. Yeah.
Sure. So the first thing is the main reason of introduction of a corporate tax in UAE, it's obviously to align with the best practices across the globe and everything, but So the other reason is that UAE is part of the inclusive framework under OECD, where there are almost more than 140 countries which are a member of the inclusive framework across the globe, which have committed to a global minimum tax of 15% for multinational enterprises who exceed the revenue threshold of 750 million euro. Now, to achieve the objective of implementing a global minimum tax and being a signatory of the inclusive framework, UAE had to bring in a corporate tax. That is one reason. Second is that UAE was put in the grey list for investment purpose for UK and other international bodies to bring in the investments to allow the seamless trade in the goods and services. UAE again committed to a corporate tax to bring the exchange of information, to allow seamless exchange of information between different countries. That's where these minimum BEPS standards comes into play. Like the economic substance regulations was introduced earlier, then the country by country reporting was introduced in the UAE. So it's all part of the global framework where UAE is aligning with all the best practices in the world and fulfilling its commitment to a global minimum tax of 15%.
Okay, so just to add what Prateek has said, I think corporate tax introduction at such an early stage is obviously got to do with OECD, right? Where effectively, like he said, there was this compulsion under the Pillar 2 where you would have the kind of, for the MNC, the 15%. But there is also one more element where we talk about is why is it not 15% and why is it 9%? Okay, so that is also got to do with where effectively under the OECD guidelines, if there are jurisdictions where effectively the rate of tax is not having a minimum rate of tax, and that is where the 9% comes in. Okay, so if it doesn't have that, then the jurisdiction of the parent company that would have the rights in terms of kind of charging tax on its on this the UAE jurisdiction. So that's one part of it. Okay, I think the reference was to what is the short term, medium term and long term. Actually, we don't have a crystal ball to kind of gauge that, right? Where we talk about the reductions, okay, the reductions have been primarily from an emirate perspective. And I think when you look at the emirate, each of the emirates have their own kind of budgets and their own compulsions and their own drivers in terms of what they do. So you would have seen that when we talk about Abu Dhabi, it kind of reducing certain things. Maybe you have to also look at the oil prices. Okay, so where are the oil prices going? So maybe that is also a factor which kind of would balance out these elements of the thing. But sorry, we don't have the numbers as far as how much are they going to get from corporate tax as such, and we'll have to wait for possibly at some stage for the authorities to share that.
Okay, well, a lot of things have been said by my two previous colleagues. Well, I just want to add one more thing, and this is basically on the attraction of the FDI, right? So the idea is, of course, when you have a jurisdiction that is quite transparent, then the foreign investors will have more confidence in investing into that jurisdiction. So that would be, and because it's not only the confidence from the investors themselves, but also the confidence of the country where the investors come from. So this is, I think, the reason why the corporate income tax also, or one of the main reason why corporate tax has been introduced. I mean, imagine if the UAE would still be in the grey list or blacklist to a certain extent, or as seen as a tax haven, right? So a lot of investors will have difficulties and to invest into the UAE and through the UAE, because they will be scrutinized within their own jurisdiction. Now, what we have done as well is that we did a webinar together with the UAE Embassy in Vienna last year, where we actually did, let's say, a small research in terms of the correlation between the compliance that is introduced in the UAE and the FDI inflow impact to that compliance that are being introduced in the UAE. But when we see the number, and we're talking about a number that came from the UN, right? So it's an independent number. We have seen that there is actually significant increase. Now the numbers I don't have in mind, but there is a significant increase on the FDI inflows. The more the compliance is, the more compliance is in regulation is being brought into the UAE. So again, I think in our profession, that is actually good news, right? Like someone said earlier. So that would be part from my side.
Hello. My question is about transfer pricing. Usually whenever a transfer pricing issue come, the subject matter has been always taken lightly in any organization. So whenever there is a transaction between holding versus subsidiary versus holding in terms of sale and purchases, usually it's happened that if I'm selling a product in $150 to a other customer, I will sell to my subsidiary or parents in $100. So my first question is, what is the consequences from the administrative authorities if the transaction volume is significant, and if the other way, transaction volume is insignificant? Since earlier there was no CT, so the impact will be on the CT, impact will be on our bottom line. So earlier there was no significance for these transactions.
Sorry, the question is?
My question is, I'm selling to a customer one product on $150.
Yeah.
But in the group companies, I'm selling the same product on $100.
Yeah.
So now CT has come into picture, and other countries like KSA, there is a group reporting requirement is there. So let's say we continue the same practice till next year or after next year. What will be the consequences?
Okay. Well, as long as you can find a comparable transaction with a third-party transaction that justify that price, then I think the government will always try to challenge you if they feel that they're losing tax, right? So basically this is the idea. But as long as you have a documentation, or you might want to start documenting it or start your documentation now, is that you will have a stronger position to actually continue your practice even after the introduction of the corporate tax. But again, with the transfer pricing is always providing the evidence is the most important part. So in your case, maybe you might want to use let's say a CUP method. I'm not sure how much you're familiar with transfer pricing method. There are 5 methods that is recognized within the OECD. So if you can find, let's say, controlled unrelated party transaction, so this is something that you might want to look at already. And that database should, or that information should come from, let's say, a reliable database that is officially recognized globally for now. So again, to answer your question, is that start your documentation, evidencing that the price or the practice that you have now, it's at arm's length. Look at the method that is being prescribed by the OECD. I mean, if it's trading, maybe your CUP would be the one that can be accepted better by the tax authority going forward. But if you cannot find the data of CUP, maybe you might want to use the resale price method as well. There are, let's say, 5 methods. Have a look at it, see which one you can do, and start your documentation. That would be my suggestion.
Okay. On the same time, my contention is, if I don't have any method, if my price is not justified by any method, that why I am selling in $100 to my group companies or my subsidiary companies, if I say I am dumping my surplus production, so then it is workable. If I am selling my surplus production or the production which I cannot sell to other customer, so that justification is viable.
Well, in my experience with what I've seen in the other jurisdiction is that if you cannot find a comparable transaction with a third party, the closest one, then it will be very difficult to justify. You know, if you say like, okay, you know what, but again, the government will only challenge you when they see that they're actually losing tax. There's something that you need to look at first. Because if at the end of the day, whatever you're doing is that, okay, you know what, you charge less to this one, but that means also it's more profit to the other company, and still that company is paying tax to the government, then basically you just say, okay, you know what, the tax is moving from this company to that company, so you do not have any loss of tax, right? And the government should not have the reason to actually challenge you. Because usually the challenge is, again, is only coming when the government realizes that they're actually losing the tax money. But going back to your question, I mean, if the reason is really an internal reason that you are dumping, but then you cannot find, well, let's say that transaction, you cannot find to be done with a third party, then I would say it would be very difficult to justify if you are being questioned by the tax authority.
Hi. So my question is on the applicability of corporate tax to entities or sectors that are already subject to some form of taxation on income. For example, the oil and gas sector, branches of foreign banks. Does the PCD cover this, or it is scoped out or scoped in? If you can throw some light on that, thank you.
So that's a very valid question. So if we see currently UAE has an emirate level taxation, which is subject for oil and gas companies which are involved in extraction of natural resources, and it is also applicable for foreign branches of the banks, branches of foreign banks. So here what they have said in the public consultation document is, since the emirate level taxation for the natural resources companies is already much higher than the corporate tax rate proposed, these companies will be exempt from the UAE corporate tax. So if you are involved in the extraction of natural resources, you will not be subject to corporate tax. Second thing is regarding the banks would be subject to UAE corporate tax. So what is most likely is the foreign banks which are being subject to an emirate level taxation right now would be brought or regulated under the proposed corporate tax regime.
Hi. Thank you for the insight into the corporate tax. My question is more so on the tax planning part of it. So you know, one of the ways to manage the profit is increase your expenses. Okay, so I can increase my director expenses, I can increase my ownership, whatever, salaries. How do you think in the current scenario when there is no personal income tax, these will be challenged and questioned by the tax authorities?
So I think there is the element of connected persons. Okay, and whatever you kind of described, they all come under the connected person. So we need not wait for the personal income tax. These would get questioned under the corporate tax itself in terms of, again, the ALP perspective, right? So if you say that I am today deploying a person or a related person for a certain activity, right? So the question which would arise is that what the job is being done, what is the normal salary norms? Again, these are all hypothetical which we are taking from our example, yeah, but that is what the principles are. Okay, in terms of when you talk about connected persons, is that whatever the salary you're paying, because if you say an MD or you say, you know, whatever the designation, right, does it commensurate to what, possibly you have to start drawing a job description, okay, and then seeing that, is that a comparable kind of salary? Because if you know, kind of, as chartered accountants, we start using our ingenuity, yeah. So maybe that's also we need to be aware, is that there is an element of how does it compare with the market kind of salaries as such.
Considering, you know, as pointed out by Markus, there is no comparison available in the market as of now.
Yeah. Well, Yes, and in terms of salary, I think yes and no. Question is that nowadays, if you look at the newspapers, which actually sometimes annoys me as well, that all of these recruitment companies start saying, okay, you know what, based on our research, this is the salary for everybody. And then once they look at once I look at the sampling method, it's like, okay, well, is it representative or not? So, again, yes, I say that, but if I look at the other jurisdiction, so one jurisdiction, let's take an example, Austria, where I used to practice as well. They were saying, okay, you know what, they might have a certain threshold, right? So, for instance, over there, what I've just discussed with my colleague over there in Austria is that they're saying, for managing director, there is a limit that up to 500,000 euros of salary costs, not just the net salary, but salary costs, you can deduct from the it is allowed to be deductible for a corporate tax calculation perspective. But anything above that it is not allowed to. So the UAE might create a certain threshold for a certain position for connected person, just to simplify the rule. And also they might also incorporate certain safe harbor as well. Safe harbor method that you say, okay, you know what, certain threshold or certain percentage is acceptable for us. So this is what I expect to come within our jurisdiction. Because again, to start justifying for every expenses with transfer pricing documentation, I do not see the practicality there. Okay. Yeah, I mean, you of course you can, but it's not practical, right? I mean, for every transaction that, let's say, I mean, what you've seen so far is let's say, especially with the local group, right? You have a board of directors that consists of, let's say, 5 or 6 people, and then of course you're going to remunerate this person. The question is that, okay, I mean, should I remunerate that person 10 or 15 or whatever it is? So what is the benchmark? If it's a stock listed company, maybe it's easier to benchmark because it should be disclosed in their annual report to a certain extent, but even then it's very difficult in this part of the world to even get that information. But how about for the private group? How are you going to justify? So I think what happened is that there will be an anti-abuse mechanism by putting a certain threshold. That's my...
This is regarding a financial year or choice of financial year for corporate tax purpose. Corporate tax purpose. Actually, in the mainland, I am having a calendar year. Now I want to change it as of 31st of May, means 5 months more, so that I can get 5 months benefit on the tax part of it. I can get my memorandum of association, get it changed, or whatever document required. Is it possible? Second question, I am having a business in free zone. That is also calendar year. Okay. There, whether I can still carry on with the calendar year. I am having 5 months gap, I can get more time to file a return in free zone, file a return in mainland. And that is the reason I can put it while changing the financial year for tax purpose in the mainland.
Okay. This is the chartered accountant brain talking. So I think at this stage, obviously you can't take any steps. Okay. So I think we need to wait for the laws and the, basically the regulations, okay, to kind of see that how this is going to farm out. Okay, so I think as long as they do not prohibit and there is no transition related elements coming into play. Okay, so that is what you need to look for. Because I think when we were doing our presentation, generally this was a question that we put in, that should I change my financial year? Okay, all that we are saying is that this is not the time for it. Okay, let the law and the regulation come out and some amount of clarity come in, and then possibly at that time you can evaluate. Of course, at your own risk.
Hello. Thank you for this wonderful insights. Just one question. Is there any light thrown on charities or non-profit organizations that are working in the UAE? What is the taxability of there?
Okay, so the public consultation document again talks about exempting certain businesses, which includes your companies which are already subject to emirate level taxation, like natural resource companies, government companies doing a sovereign or a mandated activity, and this list also includes charitable organization which are involved in the religious promotion and there are certain charitable activities they are doing, provided they have to apply to the Ministry of Finance or the FTA for getting that exemption. Once they get the exemption, the name of that charity or that organization would be listed in a cabinet decision. So if your name is listed in that cabinet decision for exemption purposes, you will be exempt from corporate tax. But if you are not listed, then you will be subject to corporate tax. So you will have to basically, before the law gets implemented, before you apply for the registrations and all, you need to see first if you are doing these mandated activities, and if yes, you need to apply to the relevant authority for getting the approval. And even same thing from a deduction perspective also, that if a business is making any donation or any kind of charity, if they are making to an approved organization, then only it is deductible for business purposes. But if you are making a donation to a non-registered organization, then that expense is not allowed for corporate tax purposes as well.
In continuation to this question, it is more relevant to our chapter now. So do you think, a non-profit social or professional organization, it will be covered under public benefit organization and they can probably apply for the exemption? I'm just giving you example of maybe our chapter, and there are a couple of, the social organization registered in UAE as well.
This is really interesting, and I would say that we need to wait for the detailed guidelines what are enumerated under the law, because right now what they have said is a very brief, it's just very brief about the exemption. Like they have said that if you are doing any social, religious, cultural activities, you can apply for the exemption. Now it's subjective. First is what will be these conditions, which will be detailed under the laws and regulations. And the second case is, even if we fall under that, when we have to apply to them for their approval. So when the FTA or the Ministry of Finance reviews our application for exemption, how they review these, they will see, okay, this is a non-profit organization set up for promoting religious activities, cultural activities for the benefit of the members, how they perceive these activities and whether they actually give these exemptions or not. Now VAT law also has a similar provision which talks about the VAT refund for charitable organizations and everything. So it could be kind of linked from that perspective. But we need to honestly wait for the law and regulations for detailed guidance.
Most of the organizations in UAE, they follow IFRS, and holding companies, they prepare their consolidated financial statements. Now, the holding company, they may have income from the subsidiaries which in the form of dividend, whereas they have their own set of income. So, do you think that the holding company has to prepare their separate set of financial statements on a standalone basis, and whether these needs to be get audited in order for the corporate tax purposes? So, what possibility you see there?
So firstly, for holding companies, dividends, what they have said is, if you are getting dividends from a local UAE company, these are exempt for tax purposes. That's the first point. Second thing, now if we talk about the financial statements or the IFRS, like Umesh said in the beginning, the public consultation document does not mandate for a company to maintain an audited financial statement. However, you will need some sort of accounts, be it a management account, certified or not certified, which conform to IFRS. Because when the FTA, the regulatory authority, will come for an audit, maybe 3 years, 5 years down the line, like Girish said, it's they will come before the statute of limitation ends. So when they come, their basis of comparison, why the need for reconciliation is there, is that you need to have the financial statements, right? It can be not unaudited, but these financial statements have to be there. And you need to confirm the reporting what you have made in your corporate tax return conforms to these financial statements, and if there are any variances, it needs to be supported by the reconciliations and the reason of differences.
Hello, good afternoon. I have one question regarding the effective management control. Because you have mentioned that
I think again, as chartered accountants, and to be prudent, it's always better to have a standalone financials and audited financials. Yeah, so I think the substantiation element. Otherwise, you need to do from, the consolidated financials, you need to draw reconciliations and maintain all of that, right? So the best evidence is having separate audited financials, and especially if the income is substantial, then it makes sense to have the audited financials.
Now, I just want to add also what they said earlier on But if you look at most corporate law in that regulate companies, free zone or mainland, they always mandate you to have auditor anyway. So I think what will happen is that currently certain free zone might not impose it, certain emirates might not even impose it for you to file your audited report. But now, although it is actually already in the law, so I think for now, apart from the enforcement from the regulator, the licensing authority, you might need to prepare, or you have to start following also the practice of having audited account for tax purpose. So I mean, I don't see the reason why you should not have auditors going forward once the tax law is introduced, is already in place, because there will be another motivation to have an auditor.
Good afternoon. I have one question regarding the effective management control. Suppose I am the 100% investor of a foreign company, and all the conditions regarding the effective management control, I remember that all board meetings should be there, CEO should be there, and accounts should be kept there, and should be audited there. All the subject to all the conditions are complied with. Suppose I am the 100% ownership, but theoretically all conditions of effective management control is there. But what will be the relation between effective management control and 100% ownership, suppose ownership control? And at the same time, I want to say that suppose instead of investing the funds as an equity investor, suppose I am investing as a loan funds there, as a 100%, what will be the tax implication in these two scenarios? At the same time, I want to say that regarding the board meetings, since I am the owner or I am the major in the funder, I can say call the board meetings here in Abu Dhabi, or I can go there, I can attend the meetings there, or Zoom meeting or Google meeting, no need to be here in Abu Dhabi or in the overseas, maybe in different places we can sit. So how you can?
So basically, just to summarize your question, I mean, so you are basically saying, okay, that there is a company located overseas, you are here, you are basically not a official director of the company, but you may be a shareholder or a promoter of the entity. How do we establish if there is an effective management and control? Because in the local jurisdiction of the company, you are doing the filings, there is a board of directors, there are minutes of meeting being prepared. Yeah, you are the owner here, yeah. So this is basically the classic case, like there is a case law of layer state BV, which we were discussing earlier, wherein the promoter, he was not in any official capacity connected with the company. He was not on the board of director, he was not an employee, he was nothing. But what was happening is this promoter, since it's his company, his interest lies there, he was taking the decisions about the management, about the control, online, visiting, like he was basically in a different country resident. When the court evaluated this case, they said that, okay, we will see what was the effective place. Like, let's suppose you have a company in maybe UK, but you're managing it from here. In UK, it could be that there's a director who is just, signing on the decisions which you tell him to take. You are telling him that, okay, let's say sell something at X price to this company. He's just, okay, confirming it. He's signing the contract. You tell them that, okay, let us merge with this company. Let us borrow the loan from this country or whatever. He is just signing this. He is acting as a rubber stamp. But yes, as per official documents, he is the signatory. He is the one taking the decisions. He is the one who is, calling all the shots. Now, this is where the facts become relevant. And like I said, yeah, you are just the owner. Yes. Yeah, you are owner. Secretaries are there. But the main thing is, it's about substance over form. When we talk about control, management, it's about substance over form. In substance, if you are not controlling the company, you own 100% shares of a company, but you have given it, you have hired a finance manager, you have different people running the business. They are the one who take the decisions. Then even if you are the 100% owner, the effective control could be with them. Effective control and management of the company. Or there could be a scenario where you, even though have a team of experts on the ground, but the key decisions, okay, they do their study. They tell you the feasibility studies, maybe we should invest this amount, we should do these, like they come up with 3 options. But you are the one who give an actual sign of that, okay, let's go for option A or let's go for option B. Sorry? Then that's where the place of effective, then that's where the place of effective control and management lies. Yes, so basically you will have to register this company in UAE for corporate tax purposes, show this company's worldwide income in UAE, subject it to tax at the standard rate. However, as per the PCD, you may be eligible to get the foreign tax credit if you have paid the taxes in, let's suppose, other country. Whatever income you are subjecting it to tax here, you may be eligible to get the foreign tax credit.
So I think you need to basically, I think you need to determine where you want the poem to be, okay? You need to determine where you want the poem to be and then ensure that the poem is there. So today, you know, when we talk about it, you know, even there are cases where I think even when we talk about permanent establishment and all, they're saying that if somebody is on a holiday in some place, right, you should not use that place for any decision making. Okay, so I'm just giving you a hint about, you know, how you, I think it's the first thing is to determine where you want your poem to be and then accordingly manage the entire affairs that way.
Thank you so much. So in the interest of time, we'll close the Q&A session here. But please feel free to connect with our speakers during the lunch. And thank you so much all the speakers for taking our questions so patiently. And I think you all have done tremendous job. So you deserve a huge round of applause.